Good day, fellow investors. Very requested stock for me to analyze now, and a stock that has been down but very good business is of course Google. I've made a few videos in the past. This is the stock valuation, great business at a fair price. Now the price is even a little bit lower, so back to where it was a year ago. And also Seth Klarman owns Google in his portfolio. If we take a look at the stock, it has been down 21% over the last month and something. So many ask if it is an opportunity here. Well, it is a much better thing than buying here. That's mathematics. But then again, if you look at the long term, Google is a compounder, Google is growing, so you will probably never see these levels again, even if it would be nice. However, you can see the compounding line going, so the lower the price, the better, and then it's about seeing how Google fits you in your portfolio. The conference call, so much of it, so of course, they discussed new product highlights. You can read it on the Google Investor page. Artificial intelligence, new search, so multi-search in Google. So they're always investing, always doing something new, something better for users. Of course, YouTube, where you're watching this now, growing the community. I really like also how they do it and the tools they offer. So they will ask for more live. I'll do that as soon as we move into new house. So we're working on that, you're watching, so everything looks great, and that reflects into the revenues that have grown 23% in the first quarter, so really good, high operating income, good margins, and Google just keeps on delivering. Plus, they have now said that they have increased the stock repurchase to 70 billion, which is already significant when comparing to the market cap, so about 5% of the business returned to shareholders. Of course, the lower the stock price, the better for share repurchases. You get more bang for your buck. And they have also announced a stock split. So it's counterintuitive a little bit with repurchases, more about repurchases in this video here. But stock split, they can allow more buyers. Someone who wants to buy Google on a monthly basis cannot put $2,000, but if they make a good split, 200 can be possible, or even 20, depending by how much they split it. Usually that's a positive for the stock market, more interest for the stock, so that could also be a catalyst over the year for Google. I'm usually a value investor, so I don't put too much attention for that, but it's always interesting. If we look at the money made, so revenues have doubled in the last 4 years. They are investing in things that are necessary, and this is just a comparison to Facebook. Google search, you get value, you get education on YouTube, entertainment, you know what you want, and you get that from Google. Facebook is more about that social, Kardashian, this and that, and sometimes you don't really need that. And that's what I also sense, the switch from, okay, Facebook or what my friends are doing, the terrible video for creators. I tried Facebook 2 years ago. Maybe they improved something, but they were really terrible. So they didn't care. They were behind, maybe focused on something else. So there is a different, I feel, risk and reward with Google. If you check the search engine market share, it's going up 92% and stable there. And if you search something, you likely will be using Google. And therefore, I would say that it has a higher moat because it created value over search, over creating value for the user instead of entertainment, which is what the competitors do. And if something more sexy, like TikTok, let's say, comes, and then that takes advantage, that takes watch time from the entertainment, but the value, the Google Maps, this sticks there. So that's a sensing difference there. And there is the growth, they are investing also, number of employees going up. So if we go to my table, my valuation table that you can download for free, we have Google here. This is the link to the previous analysis, but if you click, you can also play around with the template, and I have put here earnings per share of 112, which is the 70 billion they made and they will likely make. And if they grow at 15%, with the buybacks, 5% growth from buybacks and 10% growth from, let's say, the business, if they grow just 10% the business over the next 5 years, and then 10% consequently, so just buybacks, etc., the terminal multiple is still 25, which is higher than the current market. So then the stock price is extremely undervalued compared to the valuation for a 10% return. Maybe we should put the valuation just to explain now the market, what the market is thinking, and then still undervalued at the current valuation for a 10% return. Of course, if they grow faster and the terminal multiple returns to where it was a few years ago, then you have more than a double and Google stock at 10,000 in 10 years. But let me give you my conservative estimation. And when will Google become a value investment for me? Just 10% growth rate, extremely conservative, I know, but what can I do? 7% growth rate next, discount rate of 10%, okay, terminal multiple of just 15, we are now at 20, and then the present value for a 10% return is 1,300, but this would be an absolute bargain, great buy at current situation with the business. Sounds incredible, but it was trading close to there, so if it goes lower, I'll start considering accumulation. Now it's already good, but it depends on how good you want it to be. If we look at the expected returns, let's even be more conservative. Let's say interest rates go up and the terminal multiple becomes 15. You are still in for a 9% likely return over the long term with conservative growth rates, so 9%, 8%, which is a great return for 99% of the people out there. So when it comes to Google, it's all about the thesis there. It's all about how Google fits your portfolio. It's a great business, great financials, great growth, great moat, great everything. And just think, okay, Google, how does it fit my portfolio? If we go to cheaper than Guru, we can see Seth Klarman, he bought here, so before the crash, or here, and then sold a little bit, but then bought again as things were really improving for Google, sold a little bit here, and we still don't have the data whether he did something in the last quarter. But look at the portfolio, 6%, so it is to be there, it is value already from a growth perspective, and then you can see how this and how much exposure you want for a great company like Alphabet. Plus there are all these growth initiatives, bets that Google makes, but Google invests in things that are getting traction already and invests small sums of money in something that might become huge. That's Google, we all know. Alphabet, Google is just one part of that, and you have to see whether you want to own it for the very long term. Thanks for watching. Let me know in the comments whether Google is for you or not. I think it's a great business. You cannot go wrong if you take a long-term strategy of accumulating. I'll see you in the next video.